Hello friends, welcome to CEC Live Lectures. Dear friends, today in this session we are going to continue further in our series on business ethics and CSR. Dear friends, in our previous session we discussed on desirability of ethics. Today also we are going to get in-depth knowledge on today's topic. Dear friends, to stop unfair trade practices, the ethics are mandatory and are required. So friends, let's understand more the need of the ethics in the business. So friends, for the discussion on the topic, we have with us in our studios Dr. Namita Rajput. Dr. Namita Rajput is a principal in Sri Aurobindo Evening College, University of Delhi. Dr. Rajput is a prolific professor too, who is the author of numerous books. A number of her books are admired by the students and academicians worldwide. Friends, if you wish to ask questions from Dr. Namita Rajput on today's topic, then do call us through our toll-free number. Our number is 1-800-110-430. I repeat, our number is 1-800-110-430. Now, I would like to welcome our guest, Dr. Rajput, once again, and would request her to continue further.
Good morning, friends. Today we have a second part of Desirability of Ethics, the Unfair Business Trade Practices. In the last lecture, we also talked about certain unfair trade practices which are happening in the market, because of which it is desirable to have and implement an inbuilt culture of ethical practices. This is not going to give the benefits to the company. This is also going to give the benefits to the company and the society at large. So under this backdrop, we are going to start again and extend our previous lecture on the desirability of ethics in the business world. There are certain unfair trade practices amongst the investors also. Nowadays, you must have seen that there are so many financial companies which are proved to be sham and which are zero, which end up dissolving the funds of the investors. So there are many unfair and unethical practices also that the business promoters adopt against the investors. The investors are allured to make investments or company deposits, often on the basis of claims which are far from reality. Promising the higher interest rates, which may be as high as doubling the deposits in a year, are quite common. Through Companies Act lays down certain strict rules on giving the false information in the prospectus. You must be knowing prospectus is a kind of an information through which the public peep into the company. You have to give so many the information which are desirable from the investment point of view, and when you see from the public point of view, prospectus is the only thing which is having in the public domain, and on the basis of which they take the vital investment decisions. Through the Companies Act lay down certain strict rules that you have to be very particular about giving certain and very clear information in the prospectus, yet the company directors are not scared of making the false declarations. Enron is the most dramatic warning the investors have ever had. Enron demonstrated the power of the corporate lie through the off-balance sheet accounting, fake revenue reporting, special financial instrument usage, and auditor manipulations. The net result has been the transfer of billions of dollars from investors and employees to pockets of the top insiders. Although the way the business leaders at Enron were accused of committing the acts of false representation, illegal tax avoidance, management fraud, and fiduciary irresponsibility. Now, there are certain more unfair practices which we see in the market against the investors. It is a dramatic case of a fraud. It is just one instance of a long list of illegal, unethical, criminal activities that are going in the hundreds of companies around the world. Here we discuss insider trading, which is a rampant unfair business practice harmful to the investors. Now we coming on to the insider trading. Insider trading happens to be the most illegal, unlawful activity which is jeopardizing the market, stock market, and the information which comes out, it is damaging for few people and only give mileage to few people. So it is a term with numerous definitions and connotations, encompassing both legal and prohibited trading activity. It takes place legally every day when the corporate insiders, officers, directors, employees engage in stock trading within the framework of companies' policies and regulations in the shares of their own companies. The type of insider trading which is usually discussed is the illegal variety. It is the trading that takes place when those privileged, armed with confidential information about important events, take a special advantage of their position and use the information to reap profits and avoid losses on the stock market, or trade to the detrimental of the general public investors who do not have such advantage of insider information. Now, when you talk about the insider information, there are certain vital and very important sensitive information which is spilled out, owing to which there is only one section of the people who are doing the insider trading. They earn lot of money, huge profits on the cost of the public at large. So, this is not definitely good, and here the desirability of ethics is predominantly most important in this case. Now, taking it further, it is the trading that takes place when the privileged and the armed one, armed with the information, and there are certain people who are definitely armed with the perfect information, confidential information about the important events which are happening, take a very special advantage of their position and use the information to reap the profits or avoid the losses on the stock market, or trade to the detriment of the general public investors who do not have any advantage of the insider information. There are certain people who have the insider information will take the huge profits and leaps, whereas there are certain people who do not have such information, owing to which they suffer losses, and owing to which the desirability of ethics is very, very important in this case. Now, I will give you an example of Vincent Barr. According to Vincent Barr, insider dealings refer to the ability of key employees to earn profits from the knowledge or information that has not yet become public. In Black Law Dictionary, insider trading is referred to as a transaction in shares of publicly held corporations by persons with insider or advance information on which the trading is based. Now, according to Post Frederick Lawrence, insider trading is an illegal practice of buying and selling the shares of corporate securities based on fiduciary information known only to a small group of persons, such as executive and their friends, and which enables them to make profit at the expense of other investors who do not have access to the inside information. Insider trading refers to a situation where a person having access to important or confidential information about financial trends of the organization uses it to buy or sell the stocks for his advantage. Now, coming on to the concept of insider and price sensitive information. The Securities and Exchange Commission, that is the SEC, the stock market regulatory authority in USA, has interpreted the insider in a very broader sense to mean anyone who buys and sells the stock based on non-public information, whether or not the person is a corporate officer or otherwise linked to a company whose stock is being bought or sold. Trading in a company's shares based on inside information which is not available to general public is known as insider. Thus, insider trading is a concept whereby a person having a privilege to obtain a company's internal information uses it for a personal advantage. It is owing to a very vital and the predominant position which the person has in the market, which the person has in the company. He draws that information, he extracts that information for his personal benefit, owing to which he earns a lot of profit. So, it is because of his position which is obtained in a company that he uses for his personal advantage, and this is what is not desirable from the corporate, from the company's point of view also, and from the society's point of view also, because you are on a very sensitive and a responsible position. So, you are not supposed to spill out any kind of vital information which is going to impact the stock market or which is going to increase or decrease the stock market prices, etc., and trading. So, the concept of insider and price sensitive information is all about, it may include the information relating to policies, plans, future plans, instances of decision having financial implications, or the stock price sensitive information. The principal motive of insider trading is a personal gain. Now, according to Security Exchange Board of India, an insider is any person who is connected with a company or is deemed to have been connected with a company and is expected to have access to unpublished price information about the company. Thus, the term insider covers a person holding as temporary or permanent positions, officers, directors, employees in the company, including having personal relationships, auditors, consultants, analysts with the company and having access to unpublished price sensitive information. Now coming on to the concept of insider trading and price sensitive information. The first which we discussed is a person holding a temporary or a permanent position, that is on an officer level, director level, employee level in the company, including the professional relationship like an auditor, consultant, analyst with the company and having access to unpublished price sensitive information. For example, the company is going for any international tie-ups, or there is some important change which is going to happen in the company, or companies having some important merger or acquisition, or companies having some kind of a new product line added to its existing product line, or any such information which is going to impact the prices of the stock market. So, this is a kind of an information which is unpublished and not in the public domain. So, if this information is out in the public domain, definitely everyone will take advantage, and there will be a mass action in the market. But yes, if this information is used by certain persons which is in the unpublished form, and they take the advantage of buying and selling of the shares of that particular market, then this is a pure act of insider trading. Secondly, a person who is connected 6 months prior to the act of insider trading, the relative trust, Hindu undivided family, firm, etc., the above mentioned connected persons. The price sensitive information can relate to periodical financial results, dividend related information, policy changes, proposed expansion plans, takeovers, amalgamations, etc., and which may include quarterly financial results, intended declaration of interim financial dividends, fresh issue of securities, that is buyback, issue of bonus shares, major expansion plans, amalgamation, takeovers or joint ventures, any significant change in policies of the government and of the company. So, when you talk about the Insider Trading Act, 1, this Insider Trading Act is unethical. 2, it is not in the public domain. It is unpublished information owing to which a person who is having a vital position in the company makes use of that information. What is that information? Could be the quarterly results of the company, because how the company is performing, owing to which you make a judgment that whether in future the company is going to make profits or losses, etc., or maybe some intended declaration of interim financial dividends, fresh issue of certificates, buyback, issue of bonus shares, then major expansion plans, amalgamations, takeover or joint ventures which the company is shortly going to adopt, and any significant changes in the policies of the company. Now, coming on to the implications of the insider trading, almost all the literature seems to adopt a common definition of insider trading as buying and selling of securities by those connected with the company on the basis of information that is material and not publicly available. So, the literature says what? That when the information which is not published and the person takes the advantage of this information, so there is a big transaction, could be buying, could be selling, and on the basis of that unpublished information you take certain vital actions. So, definitely this is material and not publicly available. So, a person is making and enveloping the use of such information to move forward in life. Secondly, the insider trading is known to have its adverse effects. It is universally condemned and its prevention is widely treated as important function of securities regulation. In India, SEBI penalizes insider trading, and in support of the same, the following arguments are given. 1. Insider trading in its rawest forms dislocates the market and erodes the market confidence. So, this is a big thing. when the activity of the insider trading takes place, it is definitely going to impact one person who makes huge profits, leaps of profits. Number two, this dislocates the market also. Why? Because there is only one section of the society, could be a part of the corporate or maybe few individuals, who's doing transactions owing to their pre-information, and they're having a pre-information relating to the vital transactions happening in the market, happening in the company. They have a complete catch of that information, owing to which they are taking actions. So this is not only going to dislocate the market, but also sometimes erodes the market confidence also, because this is one information which is not in public domain. So only few people of the corporate or connected to the corporate are taking the best advantage of that information and moving forward in life. So this is definitely going to dislocate the market, one, and two, it is going to erode the confidence of the public at large. Number two, it is a form of a stealing. It damages the system. It only benefits the insider trading. So insider information is definitely an unethical activity, and it is not less than stealing. Stealing is definitely unethical, and from our childhood, from our right upbringing, we are taught that stealing is unethical. Stealing is something that you're taking away the advantage which was supposed to be available for all people, but you are taking this advantage. So this is definitely not good. So it is a form of stealing. It damages the system. It only benefits the insider trading. Number three, insider trading makes the vast majority of the shareholder suffers. They miss out on the value. They should be available to share profits. Insider trading makes a vast majority of shareholders suffer. So when you talk about insider trading, as I said in the beginning, insider only has the profit. Rest, all who are connected and associated with the profit and who are supposed to be the major profit holders in these transactions, are denied because they are not having, or they are not armed with the information which they should have been armed with. So they miss out on a value, they miss out on the profits, they miss out to share the profits, which is definitely unethical. So that is why I am stating few conditions in the past lectures also, and in this present lecture also, that we are stating those particular circumstances and the conditions which shows clearly that you have to have ethics inbuilt, or the desirability of the ethics. Then number 4, there are money lost by people acting on what they think is insider information, then by those who sell. So people, they earn, they lose on the basis of the insider information which is available in the market. So there is more money lost by the people because they act on the basis of insider information than by those who sell it. Now the next aspect of this is that insider trading, because of this particular act, investor confidence is eroded, the raising of capital is made more difficult, efficiency of the market is destroyed, perception of unfairness leads to disinvestment. Now you have to be very clearly understood about this fact, that when a particular act of the insider trading is happening, it has multiple impacts. One, it erodes the investor confidence. Two, the raising of capital is made more difficult because overall the confidence of the investors is eroded. The efficiency of the market is completely destroyed. Perception of unfairness leads to disinvestment. The insider trading is very, very harmful as it encourages the unfairness, wrongness, defrauding, and it is the unfair to the market, unfair to the shareholders, which creates the unfair advantage, and it destroys the level playing field. Insider trading is a game which is not very straight. People on the out ring of the market are disadvantaged. What is missing in the presence of insider trading is an informed and an honest market. However, it should not lead us to conclude that there is unanimous agreement on the implications and the consequences of insider trading. insider trading definitely is a game. It's a big game, which is not very straight, definitely, because the persons who are on a particular positions in the market, they try and manipulate and catch the information which they are not supposed to have it, because this is a very confidential information, like certain vital steps which have to be taken by the company, etc. So what they collect information, culminate every information, do a deep analysis and do a transaction. The transaction could be buying, it could be selling. But yes, what is the impact of this? The complete market is eroded, the investor confidence is eroded, there is completely chaos in the market, and definitely when the people lose the confidence, there is a outright trend of disinvestment, which is definitely also not very good. What is missing in the presence of insider trading is an informed and honest market. However, it should lead us to conclude that there is a unanimous agreement on the implications and consequences of insider trading. What is the implication of insider trading? The debate is conducted on 4 interrelated grounds: moral, ethical, economic, legal. Is insider trading morally right? One way to abuse one's position in the market is through insider trading, which refers to use of certain facts that have not been made public and are likely to affect the prices of the company's securities in the stock market. Now, another question, whether it is morally right or wrong. The use of one's official position in a company for personal gain always raises certain moral concerns, because of which the risk that one will thereby violate one's obligations to the firm or an organization. Insider traders ordinarily defend their actions by claiming that they do not deceive anyone. They see nothing immoral in it. They argue if someone has advanced information, it undoubtedly gives him an advantage over others. If the advantage is used without harming anyone, where has wrong been done? There are certain arguments in the favor of insider trading. Insider trader act as a price accelerator, followed by the proper leveling of the prices of securities. It is a 3-step forward, 2-step backward phenomena. Now, what is it? The prices rise initially, but come down to a particular level, and then an onward rise take again place. So, it tends to cause a very correct price to be reached more quickly. It is good for the market as it drives the market, it provides increased activity in the market, it forces the information into the market, it allows the market to reassess the stock prices, it is informationally very, very efficient, it works as a market mechanism, it adds to the liquidity to the market, benefiting the government with additional revenues. But moral concerns arise definitely when the insider trading takes place. Everything takes a pace, everything becomes a speed. When the information is used, transactions happen very quickly, the information enters the market quickly, there is an up and down in the market, you try and buy, you try and sell, the market information is entering into the market very quickly, which gives a lot of impetus to the market. The market becomes very informationally efficient, and there is a market phenomena which works, and it adds to the liquidity in the market because you start performing the transactions. And since the investor sentiments play a vital role in the Indian stock market, so there is a tendency of the other people also to behave in the same manner. So there is a quick pace, quick surveillance in the market, the liquidity enters into the market, and there are additional revenues which takes place. But what about the moral concerns? It is definitely a matter of very, very important thing to be considered. The moral concerns arise even from the indirect injury. The insider dealing raise intriguing moral questions. Sometimes It is termed as an immoral based on efficiency considerations. If there is an equal access to the information, perfect information in economic terms, then the market is said to be very efficient. If there is unequal access to the information, imperfect information in the economic terms, then the market is said to be inefficient. Insider trading, whether it is morally right or wrong, let us discuss on the moral grounds. It is a breach of the trust by the insiders, number one, because when you are stealing the information, this is not morally good. So that means what? It means a breach of trust. You are trying to steal the information which you are not supposed to do it, and you are acting on that information, either buying into the market or selling into the market, which is definitely complete breach of trust. Number two, insider is a kind of a fraud by the insiders. It's a complete fraud because these activities are not considered to be morally good and you're doing it. So it is definitely a sort of a fraud. Number three, insider trading is against the principles of fair market. Insider trading damages the investor's confidence in the security market. It is debated a lot as to whether or not insider trading is an unethical practice or not. Insider trading is considered unethical because it affects the prices of securities in the stock exchange, rendering it unstable. It allows the insider to misappropriate the funds of investors of the advantage of insiders, substituting the public good by the private good. Then of course, it dislocates the market and erodes the investor confidence. It dislocates the market and erodes the market confidence, and it destroys the efficiency of the stock market, and it is a sort of fraud by the insiders. So with this, I hope you understand what are the moral impacts of the insider trading. Thank you so much.
With this note, thank you, ma'am. Thank you so very much for giving us this session. Friends, you are requested to be with us as we are back after a short break. Thank you. Hello friends, welcome back to this session. Friends, as you know that today we are talking on desirability of ethics, and for the discussion on the topic we have with us in our studios Dr. Namita Rajput. Dr. Namita Rajput is principal in Sri Aurobindo Evening College, University of Delhi. Dr. Rajput is a prolific professor and she has answer of your every question. Friends, if you wish to ask questions from Dr. Namita Rajput on today's topic, then do call us through our toll-free number. Our number is 1800 110 1-800-110-430. I repeat, our number is 1-800-110-430. All dear friends are requested to call in the last 10 minutes of the lecture so that first you get in-depth knowledge on the topic, and yes, we promise to give answers to your questions through Dr. Rajput. Now we would like to welcome our guest, Dr. Rajput, once again. Hello ma'am, welcome to the session.
Welcome to the second part of the lecture, but before we move on, let me give you a recap of what we did in the previous session so that you have a connectivity. Now we talked about that there are certain unfair trade practices when you talk about the financial market, and this is a matter of concern because the investors, they try and invest in a very very judgmental and rational way, but eventually what they get is zero. So that means there are certain unfair trade practices which are happening in the market, because of which they suffer a lot, they have a lot of disadvantage, and they are put behind. So what is this? So let us discuss now. The investors, they are definitely sometimes they face unfair and unethical practices the business promoters adopt against the investors, and of course the investors are allowed to make investments or some kind of deposits on the basis of which is the claims which is very far from reality. So this is a matter of again concern, and here the desirability of ethics come. So there are certain other positions also, the matter of insider trading and the promotion of certain dubious interest of certain people who are at the advantageous position. So they do a lot of fraud and misconduct activities which are definitely not good from the investors' point of view. So there are certain strict compliance which the Companies Act has to do. Like for example, the Companies Act lays down certain strict rules on the basis of the false information given in the prospectus, yet the company directors are not scared of making false declarations. Enron is the most dramatic warning the investors have ever had. The Enron demonstrated the power of the corporate lie through off-balance sheet accounting, fake revenue reporting, special financial instrument usage, and the auditor manipulations. The net result has been a transfer of billions of dollars from the investors and employee to pocket of the top insiders. Along the way, the business leaders at Enron were accused of committing certain false information, illegal tax avoidance, management fraud, and fiduciary irresponsibility. It's definitely a dramatic case of fraud. It is not just the instance of a long list of illegal, unethical, and criminal activities that are going in the hundreds of the companies across the globe. Not only this, we will discuss now and we have already discussed the concept of the insider trading. It is purely a particular act and it has different connotations and the meaning. So we must understand that every now and then we talk about and we hear in the market that the Insider Trading Act has done this, insider traders have done this. So what is basically an insider? Insider is one who is in a very advantageous position, either on a particular position of a director or a particular important position, owing to which he has the access of the vital information which is unpublished and not in public domain. So what he does, he take and catches the information, culminates everything, analyze everything, and take a particular action of the investment in the particular market. So usually we call it as illegal variety. Why it is illegal? Because supposed to use that information which is only going to give the benefit to you, not to the public at large. It destroys the market, it disorients the market, it erodes the public confidence. So all these activities are tantamounting to call it as a illegal variety. Then we discussed about the concept of the insider dealings by Winsard Barr. Insider dealing refer to ability of key employees to profit from the knowledge of information which has not yet become public. So it is referred to as a transaction in the shares of publicly held corporations by the person with insider or advance information on which the trading is based. Then we discussed about the insider trading according to Post Frederick Lawrence. Insider trading is an illegal practice of buying and selling the shares of the corporate securities based on fiduciary information known only to a very small group of persons such as executive and their friends, which are called as insiders, which enable them to make profits at the expense of other investors who do not have the the access to the particular inside information. The insider trading is definitely a particular position where a person has an access to the important and confidential information about the financial trends of the organization. They use it either to sell or to buy. And there is one commission which is called as a Security Exchange Commission, which is definitely the Stock Market Regulatory Authority in USA has interpreted insider in a very broad sense to mean anyone who buys and sells the stock based on the non-public information, whether or not the person is a corporate officer or otherwise linked to the company whose stock is being bought or sold. Trading in a company's share based on inside information which is not available to general public is called as insider trading. Insider trading is a concept whereby a person having privilege to obtain a company's internal information uses it for his personal advantage. It may include information relating to policies, plans, future plans, instances of decisions having financial implications or stock price sensitive information. The principal motive of insider trading is a personal gain. Now, according to Security Exchange Board of India, an insider is one who is connected with a company or is deemed to have been connected with a company and is expected to have access to unpublished price sensitive information about the company. Now, who is an insider? We discussed. So, just a small recap. Insider is a person who is an officer or a director or an employee in the company, including having professional relationship, could be an auditor, consultant, analyst with the company and having access to unpublished price sensitive information. A person who is connected 6 months prior to the act of insider trading, a relative trust, HUF, concerns, firm, etc., the above mentioned connected persons. The price sensitive information can relate to periodical financial results, dividend related information, policy changes, proposed expansion plans, takeovers, amalgamations, and may include the quarterly financial results, intended declarations for the interim dividends, fresh issue of any buyback, issue of bonus shares, major expansion plans, any merger and acquisitions, and any significant policy which the company is shortly going to adopt. If this particular price sensitive information is used by only a niche people, definitely the other people would be disadvantaged and they will not earn, only except the person who are using this information. Although almost all the literature to adopt a common definition of insider trading as buying and selling of securities by those connected with a company on the basis of information that is material and not publicly available. The insider trading is known to have its adverse effects. It is universally condemned and its prevention is widely treated as an important function of securities regulations. In India, SEBI penalizes insider trading, and in support of the same the following arguments are given. Insider trading in its rawest form dislocates the market and erodes the market confidence. It is a form of stealing, damages the system, it only benefits the insider trading. Insider trading makes the vast variety of the shareholders suffer. They miss out on a value, they should be able to share the profits, and there is more money lost by the people acting on what they think in insider information than those who sell. Then because of the insider trading, investor confidence is eroded, the raising of capital is made more difficult, the efficiency of the market is destroyed, the perception of unfairness leads to disinvestment. The insider trading is very harmful as it encourages the fairness, wrongness and defrauding. It is an unfair to the market, unfair to the shareholders, creates unfair advantage, and it destroys the level playing ground. Insider trading is a game which is not straight. People on the outer ring of the market are disadvantaged, and the people who are inside the ring, they earn profits. The people who are inside the ring are called insiders. Not all the people are insiders, only the few people who have deceptive the potentials are going to take some wrong action against the company and take the advantage of that unpublished information which is available. What is missing in the presence of insider trading is an informed and an honest market. However, it should not lead us to conclude that there is unanimous agreement on the implications and the consequences of the insider trading. The debate is conducted on 4 interrelated grounds: moral, ethical, economic and legal. Is insider trading morally right? One way to abuse one's position in a company is through insider trading, which refers to a use of certain facts that has not been made public and are likely to affect the prices of companies' securities in the stock market. The use of one's official position in the company for personal gains raises more moral concerns and defend their actions by claiming that they do not deceive anyone. It seems to be immoral. They argue that if someone has advanced information, is undoubtedly giving him the advantage over the others, and if the advantage is used without harming anyone, where has wrong been done, there are certain arguments in the favor of insider trading. Some of these examples are what? Insider trading acts as a price accelerator followed by proper leveling of the prices of securities. It is the 3-step forward, 2-step backward phenomena. Prices raise initially, come down to a particular level, then onward rise taken place. It tends to cause the correct price to be reached and more quickly. It is good for a market as it drives the market, it provides increased activity in the market and it forces the information into the market. It allows the market to reassess the stock prices. It is informationally efficient, it works as a market mechanism. It adds liquidity to the market, benefiting the government with additional revenues. The moral concerns arise even when from the indirect injury the insider dealings raise intriguing moral questions, and sometimes it is termed as immoral based on efficient considerations. If there is an equal access to the information, then the market is said to be efficient. If there is unequal access to the information, then the market is said to be inefficient. Insider trading is unjust or moral grounds. Insider trading is a breach of trust by the insiders. It's a sort of fraud by the insiders. It is against the principles of fair market. Insider trading damages the investor's confidence in the security market. It is debated a lot as to whether or not the insider trading is an unethical practice. It is considered to be unethical because it affects the prices of securities in the stock exchange, rendering it unstable, and allows the insiders to misappropriate funds of the investors to the advantage of insiders and substituting the public good by the private good. It dislocates the market, erodes the public confidence, and it destroys the efficiency of the stock market and is a fraud by the insiders. Now, is insider trading economically efficient is a big question mark. The school of thought that defends the insider trading provides an ensuing series of arguments in the favor of economic efficiency and attractiveness. For them, in an environment where insider trading is allowed, insiders will benefit from their private information, but they will not harm outsiders who anyways act in accordance with their own discretion. This reflection the well-known concept of victimless crime. The shares will be traded on a real information and reflect the actual status of each company rather than hypothesis rumors. The market will be more fair and efficient. Movements of the share prices will be accelerated, and so will the resolution of wealth transfers. This will further boost the market efficiency to the benefit of both insider and outsider. The market itself will regulate any excesses of the insider trading. This argument refers to a famous invisible hand of Adam Smith and builds an idea that every market, if left unregulated, will find its equilibrium at an optimum level. Inside the companies, the executives will have more incentives to put together the deals, discover the market, invent products, because they will be able to be the first one to use the relevant information to trade in the market and make the personal profits. As a consequence, their own interest will be in line and that of both their company and shareholders. Since executives will be able to earn substantial amount of insider trading, companies would not have to pay them large bonus anymore. They may even be able to reduce their salaries. These corporate savings will be subsequently transferred to lower prices for the products to be benefit of the end consumer. The response of the opponent of the insider trading on economic efficiency ground is relatively very weak. It is called victimless crime. The main encounter arguments are: there is no evidence that invisible hand can deal with the excesses of insider trading. The concept of the free market, which is forcefully defended by insider trading proponents, is violated since the market is actually regulated by the holders of inside information. If the free competition provides the best economic results, the insider trading by definition cannot make the market more efficient. Executives can equally benefit from using the inside information regardless of the positive or negative nature of the news. Consistent price manipulation from insider will make investor trust deteriorate and will boost the unofficial and make false information, so the market will fall into unreliability and inefficiency. Insider trading is not only economically inefficient but also dangerous. The idea of victimless crime is inconceivable to anyone actually involved in the stock market. This is derived from a simple principle: the profit of one investor is the loss of the other. Hardly anyone denies that most important asset of any market is its credibility and transparency. The appropriate legal handling of insider trading is directly connected with its economic and ethical aspects, which have been already discussed. However, there are some additional interesting points in the favor of making it legal. Even if the insider trading is unethical, it is an issue of between the shareholders and their executives. The state should not bear the cost of intervening, since they should not be having a responsibility of those whose interest is directly affected, that is the shareholder. Due to practical reasons, even the most severe law cannot prevent some kind of inequality in the information. Now, should the insider trading be legal? Again, is a unethical and a moral question, because we have already discussed the plus and the minus points, the implications, the moral grounds of insider trading. Now, the question is, should the insider trading be legal? Because there is a principle of Adam Smith that somewhere the market will equalize and will be working on an optimum and the equilibrium level. Now, should the insider be legal? We are heading towards this. The fraud still exists despite the myriads of the legal restrictions and remedies against it. The arguments which support the legal framework to curb the insider trading are: companies do not have the required resources neither to monitor transactions continuously, extensively, nor to impose adequate penalties. They could suppress the insider trading. So, this is the important irony of the situation, that when the insider trading happens, we do not have a complete surveillance mechanism, or the transactions continuously under the scanner or continuously monitoring them, because of the policies which are adopted by the corporate. Neither they have the adequate penalties to be imposed on them, so they could suppress the insider trading. By assuming this responsibility, the state is offering a valuable service to companies. Societies has a stake in the fiduciary relationship, since the companies are its productive molecules. Anything that endangers the company nature and the survival, like the breaching of fiduciary relationship, should be prevented. Insider trading causes harm, whether it to be an individual or to be a corporate or to the market. Individuals might not realize that they are victims, but they nevertheless suffer at the hands of an insider trading, because when the insider trading happens, there is a lot of loss to a particular segment, except the person who are armed with such kind of information. They sell the market, they sell into the market, they buy into the market, and with the absolute they are not having any kind of loss because of the armed information they have. So, in either case, they are the least taken advantage to be deceived. Insider trader has the effect of corrupting or debasing the market. It erodes the market confidence, it loses the investor confidence, and owing to which the insider trading is legally wrong, for which it is widely prohibited. It is morally wrong, for it amounts to a breach of trust. It is a fraud cannot be justified on either any grounds. Could be moral, could be legal, could be social. Insider trading is inherently unethical activity, and it is not just unfair, it is just plain theft. So, should the insider trading be legal? The answer is no, because you are taking lot of toll on the market. You are taking a lot of toll as far as the consumer confidence index is concerned. You are taking a lot of toll because you are putting the maximum people who are outside the ring of the company on a very disadvantageous positions. So, insider trading has a effect of corruption. Lot of corruption takes place, lot of debasing takes place. The market is not in equilibrium, and definitely it is legally wrong, for it is widely prohibited. It is morally wrong, for it amounts to breach of trust, and it's a fraud cannot be justified on either legal or moral grounds, and it is definitely inherently unethical. It is not just unfair, and it is plainly called as theft. It is well known no economic loss is caused by insider trading, but the insider trading is a question of fairness. It distorts the securities and is definitely a fraud. Almost all economically developed societies seem to have been given their verdict on the issue. If insider trading is theft, it should be banned and penalized. Many efforts have been made in various spheres to curb and arrest this practice. Laws have been enacted. Many companies have drawn a code of conduct to prevent this. Insider trading laws exist for a reason for both equity and efficiency. Now, we are coming on to the last topic of today, that is how the insider trading can be curbed, because we have seen at length what it is, the moral grounds, the implications behind it, how it affects the market negatively, how it only affects only the people who are inside the ring and called as insiders, and affects the outer ring of the people very, very negatively. There is a complete chaotic position because of the insider trading, but yes, the company does not have the mechanism to have a consistent, continuous, and a substantial way to control the insider trading. But yes, in the coming years, people have realized that this is an unethical activity and needs to be curbed. So, owing to which certain companies have made their code of conduct in this regard, that they want to control this insider trading. So, now coming on to the measures to curb the insider trading. With regard to the equity, and the regulatory authorities want to ensure that everyone involved in the stock market has access to equal information, and any information available to one active participant in the market is available to all participants. In other words, no one has unfair advantage in the market. It is argued that insider trading is market manipulation, and insider trading is a manipulator. Insider trading has not been valued favorably in any country. Both the government and industry consider trading undesirable. In the USA, the amendments in the US Security Exchange 1935 enacted the Insider Trading Security Fraud Enforcement Act in 1988. The sanctions for the insider trading includes the fine up to $1 million for individuals, 10 years jail, and civil penalties of up to 3 times the profit gained or loss avoided. The USA, with strict legislation established in 1930 and a strong record of many unsuccessful and successful cases which have been created an environment of trust, is a pioneer in the field. The UK has also a long tradition of anti-insider trading legal initiatives, albeit the less efficient. The Companies Securities Act 1985 deals with the cases of insider trading in the UK. The most importantly, the other developed economies in which much less energetic on the issue have promoted new legislations and come out with their first prosecutions during the last 10 years. The most recent examples are Germany, Italy and Netherlands. Insider trading and many other forms of corrupt dealings are very common in the securities market in India. The current insider trading regulations in India prohibit any insider from acting on non-public information or disclosing the information to any other person. Insider trader has been outlawed in India. the SEBI, that is the Security Exchange Board of India, has been given a mandate to investigate instances of alleged insider trading. SEBI has issued the regulations which prohibit the insider trading. So, it has been taken on the forefront by the Security Exchange Board of India in order to protect the investor sentiment and in order to have the desirability of the ethics, that they have been outlawed in India, and of course, there are certain mandates which have been passed by Securities Exchange Board of India. They have issued certain guidelines and regulations for the alleged insider traders, and the original law which was passed in 1992, and the SEBI passed a series of regulations to broaden the scope of the law in 2002 in India. The SEBI is trying to build investor confidence and make all efforts to prevent the insider trading. It has been forced the following regulations: the SEBI Regulations 2002, the SEBI Acquisition and Shares and Takeovers Regulation 1994, the SEBI Fraudulent and Unfair Trade Practices Regulations 1995. However, the situation is far from ideal. The number of insiders cases revealed increases each year. In spite of having so much of outlawed, in spite of having so many issues to take over, the guidelines, the mandates, the regulations which has been passed by SEBI, still the number of insider traders are increasing every day. The difficulty of the situation lies in the fact that the insider trading promises huge economic benefits to insiders, making some of them willing to take a risk, which is definitely not good. This greed is not good. On the other hand, there is a limit to how far the severity of legislation can go, and it harms the operations of the legal market. The solution could be introduction of more sophisticated technologies in order to tap these insiders, and as long as it is called as a victimless crime, can stand alone, some people will always find excuses for their own conscience. So, this is all from my side. Thank you so much.
With this note, thank you, ma'am. Thank you so very much for giving us this session. Friends, you are requested to write to us at info.cec@nic.in. If you have any feedback or query, we are going to meet again soon. Till then, take care. Goodbye. Thank you, ma'am. Thank you once again.